What's up, guys? So on Friday, the exact opposite of what I thought was going to happen happened. And the markets opened and just exploded and ripped higher. And what do I mean by that? Well, the market opened, Powell spoke at 10 a.m., and we just got this massive God candle on the hourly where the S&P 500 went up by essentially 100 points in an hour, right? It just massively exploded because Powell apparently came out dovish, and some people are saying collapsed, right, and caved in. And you might think that that's a good thing. The market thinks the initial reaction is that it's a great thing, right? Lower interest rates, everything to the moon. But it's actually a very bad thing. And in fact, it's actually made my assessment of what's going to happen that much worse. Now, before you write me off and call me a doomsdayer forever, have a look at some of the data I'm going to show you, because this is just data, right? This is just not interpretation. This is just like straight up data of what's going on and what has happened in the past. So let's move along from this God candle into what is going on, right? So just to recap, what did Powell say? Well, he said a bunch of things that are actually really scary. Basically, he's saying the slowdown is much larger than assessed just a month ago. So, okay, the economy is slowing at a much faster pace than they thought, right? And what they thought last month was that things were already not going well, but we have had these revisions downwards that were substantial. The second thing he was talking about is the labor supply has softened in line with demand sharply, right? Lowering the break even. So we're talking big moves down on the real economy. And he's saying that this unusual situation suggests that downside risks to employment are rising. So this is not normal, and the risks are going up. And that if this risk materializes, they can do so quickly, right? Again, sharply. Higher layoffs and rising employment. So if you look at what he's actually saying with the real economy, words like sharply, unusual, much larger than assessed, quickly, these are words that are telling you, I mean, it's like the car hitting a wall. Right? This is not a gradual, this is like much more violent than expected in a slowdown, is basically what he's telegraphing over here. Then he goes on to say, well, because of this, we need to consider a change in our policy. And this is a part where the market just went, woohoo, cutting rates, we're going to go to the moon. And he's saying like the existing restrictive territory now needs to shift because the balance of risk, went the other way. This is what I mean. The markets are ripping up higher because he came out and said the economy is tanking. Now, I've told this to you before. The stock market is not the fundamental or the real economy, right? The two are not attached together. They get detached many of the times. This is one more of those situations. But I want us to be more focused on what's happening on the real economy, because eventually what happens is no matter how much the stock market gets detached from reality, it always snaps back to reality, right? It doesn't stay detached forever. And so staying focused on the fundamentals and the real economy, number one, prepares you for what's going to be happening in the future when reality sets into the stock market. But more importantly, number two, is it actually impacts our real everyday lives, which the stock market really isn't outside of paper trading. And our real everyday lives center around debt, center around jobs that we have, how much money we make, and that kind of stuff. And that's what really matters in the long term of our livelihood. And what is going on is things are looking really dour. In fact, people who think that Powell, and again, I was mistaken to think that he was going to be hawkish, right? And what changed was the real economy is that much worse than he or I thought. In fact, it was so bad that it caused him to pivot from being a hawk to a dove. Now, some people are thinking, well, Powell caved to Trump. No, Powell did. We discussed this at the last episode. Powell's not caving to Trump, right? What Powell is caving to is horrific economic data. to the point where he had to pivot, even if it looks like he's caving to Trump. And this is really, really not good, right? Like, anybody celebrating the fact that this guy finally pivoted because the economic data is that much worse than anticipated has lost the narrative, right? And trust me, this is something that's it's gonna eventually impact all of us, right? Including me, because the real economy is the real world that we live in, and things are looking very, very dire, to the point where this guy had to pivot. Now, let's take a look at what happened after Jackson Hole speeches, because everybody's like, oh my God, we went up, so we're going to just straight to the moon. Well, look, this is every Jackson Hole, keynote delivered by the Fed, right? And if you look at it, we never did up to the moon. It went up and then it corrected, right? And sometimes it just went down, but we go up right here and then we go down. We go up, we go down. So this time, are we going to go up and go up? Probably not, right? We're going to go up and go down. I mean, look, I'm just showing you factual data of what has happened in the past after every Jackson Hole speech by the Fed chair. Right? And so maybe this time is completely different and it does this, but I'm telling you, that has not happened every single time in the past. Now, you might say, well, sometimes the Fed comes out and says they're going to raise rates and that's why it goes down. Or, they're probably coming out here and saying they're going to raise rates. That's why the market, no. All right, let me show you some more facts. The fact is, that's not the case, right? These are all the times the Fed came out and said, they're going to lower or hinted at lowering rates. It's pretty much every one of them, right? Came out and said they're going to lower rates, right? These are facts from Ben Bernanke, the previous Fed chair, to Powell, right? And this was the Fed funds target rate. So look, I'm just showing you data. This is a factual case where they came out and said they're going to be dovish, right? And then what happened? We went up and then we went down. We went up, we went down. So I mean, chances are, if you look at past data, I mean, you want to play the other side and think we go up, but I'm saying, like, this is going to go up like we popped on Friday and go back down. Now, it might go back up after it. That's look, we've had that happen in the past, right? So that could happen as well. But I'm just telling you, if you think we went up on Friday and it's just up away from there, that's not coinciding with the data from the historical past. I wanted to just bring this up because this is kind of sad, right? And what it is, yes, the market ripped up 100 basis points and that made the world's 10 wealthiest people $33 billion richer because they own a lot of, they're major shareholders of stock. But what happened was that the US dollar went down because of inflation expectations, what happens when Fed cuts rates, and that basically made everybody poorer, right? So again, this is an example of how when the Fed cuts rates, it is not a good thing for the common person. It only helps the top 0.01% of the rich. Because what happens when the Fed cuts rates is the rich get richer and the poor don't get richer. And that's just a fact. In fact, speaking of facts, if you look at the past, all the Fed has done when they cut rates is essentially exacerbate the discrepancy in income between the rich and the poor. They don't control where the money goes when they cut rates, right? And what's been going on is the money goes to the rich. And so if you look back in the past 20 years, all that happened is the rich have gotten richer and the middle and low class have gone nowhere. Meanwhile, inflation has gone up. And this is not a good thing, right? This makes the average person feel poorer over time. And that's exactly what's been going on. Now, if we move forward, one of the things that Powell said was he's going to adopt a new framework that removes any one of the Fed's policies has been to keep inflation and try to keep it at this 2%. He's saying we're going to throw that out the bank. And that, again, that is quite a big move, right? And people say like, woohoo, now we can have zero, it doesn't matter inflation, right? You're just going to print till kingdom comes. So that's dovish, that's bullish. But That's really not the way the professionals interpreted it, right? And if you look at this chart, which is an interesting, I mean, I follow this because it's interesting. So Bloomberg uses NLP, which is natural language processing, with a little bit of AI in here, to basically take the words that come out of, a speech, like the Jackson Hole speech, and process it and say, is that hawkish or is it dovish? And actually the machine says it's actually tilted hawkish, right? And so this is glass half full, half empty. Like, are you going to look at the information and say it's hawkish? Or are you going to look at the information and say it's dovish? And clearly the market took that information and said it's dovish, whereas the machine, which has no sentiment really, right? There's no biases, it's just a machine, is saying that, look, it's not actually dovish. It's actually, in fact, a little bit hawkish, right? And so take that for what it is. But I mean, professionals. And if you look at the people who are on Bloomberg and other like professional platforms, they're saying like actually it's not really that dovish, right? Now I want to talk about this misconception, right? There's a pervasive misconception. I don't know why. I think people just have generational amnesia and they forget what has happened in the past, and you get this new generation of youngcomers youngcomers not in age, but in trading, right? Who have never lived through the past recessions or the history long enough, so that all they know of is basically up, 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 and buy, dip, dip, buy since essentially COVID, which is like just only 5 years ago, and that's their entire history. I want to make a case here that you need to understand, and I talked about this in the Discord channel, but when you get, when you go through a recession, right, and suffer the pain, it's very different than reading about a recession and just intellectually or cognitively trying to understand what that was like. So nobody alive now really has gone through the Great Depression. So none of us know the pain and the result of that pain, the imprint it has had on our mental framework. They're all passed away now because that happened in 1929 and in the early 30s. So nobody's kind of alive. So we're probably going to repeat the same mistake again. That's probably that's human nature. Now, if you dial that forward, there's a lot of people who have just started day trading in the options market and all that ever since the stimmy checks in COVID, which was 2020. And so it's about 5 years. They don't know what happened, in the last recessions, like, the great financial crisis or the dot-com bust. So they just read about it and be like, that's not going to happen this time. We've changed gravity and there's new economics. And that's what they always say when the new generation comes. They always say this time it's different, doesn't apply to this new, we figured something out, we developed something new. And then they do this dip buying thing until they get slaughtered, right? And then after that, a new generation comes in and it's the same thing and the same rinse and repeat the cycle. There's always this new generation, right? Of this time is different, dip buying, people will never go down. I mean, if you look back in history, that's just what happens. And we're in one of those situations now. But I want to remind everybody here, right, that if you just look at what happened, and again, I'm just going to show you straight up data. There's no interpretation of this. This is just what happened, okay? And you take that, you process that data with your own brain. The markets think, and people think that when Fed cuts their interest rates, that means we're going to go up to the moon, everything's going to go up, and everything's going to just explode higher. Well, let me show you what has happened every time the Fed has cut rates. All right. The last time they cut rates, great financial recession, what happened? We had, they cut rates, right? They were raising and then they paused and they cut. What happened? We had that great financial crisis, a very deep recession that actually had deflation in it for a little bit. First time since the Great, Depression, we had deflation was back here in this recession, right? Fed cut over here. What happened? We had COVID, that mini recession. Back here, Fed cut, right? What happened? Back in .com, we had a recession. Fed starting to cut here. What's going to happen? I don't know. You tell me. You're not going to have a recession? You might say like, hey man, but this is only going back to, I don't know, since the 2000s. So that's only 25 years. Only 25 years. That's longer than most people have been in their professional career. For most of us, right? Because you got to be 20 years old to be in a professional career. So if you had 25 years, you're approaching my age, almost 45, 50 years old, right? But let's say that's not enough time, right? It's too small a sample size. So I'm not going to believe that chart you just showed me. Okay, well, let's take it. Let's take it further. Let's go back to 1955, all right? Okay, now we're talking a good 70 years, okay? 70 years back. None of us have been trading since 1955. We look at this chart, all right? I showed you since 2020, right? Now let's go further. Cut rate, recession. Cut rate, recession. Well, let's go further. 1990s. Cut rate, recession. Cut rates, recession. Cut rates, recession. Cut rates, recession. Go back to 60s. Cut rates, recession. Late 50s, cut rates, recession. Okay? So now you tell me, is that enough time? 70 years of data? What do you think is going to happen this time when the Fed cuts rates? You still think that we're going to go up into the moon, economy's great, and we're just going to fire on all cylinders? I mean, you could think that. I mean, look, again, nobody has a crystal ball. I certainly didn't have a crystal ball. My base case was that Powell's going to come dovish, but he came hawkish, right? So this is an example. Like, nobody has a crystal ball. Maybe this time there's no recession, right? Maybe. I don't believe that. Basically because of this, right? Because of this, right? So you believe what you want to. I'm going to believe what I want to. Here's the data. Nobody has a crystal ball, but you see the probabilities of what I'm showing you. Now, this person or this account posted something interesting, right? So back in 07, 08, one of the other times when the Fed started, what's interesting here is this was a time when stocks was hitting all-time highs, right? And the Fed started cutting rates with inflation around 5, which is around now, 4. Similar setup. And what happened was when they cut rates, right? What happened was stocks ended up collapsing 40% when Lehman, after a month later, happened. All right. Now you might say, I'm not saying this is going to happen, but it's an interesting thing to remember, right? Because back then, everybody thought, well, Fed was going to cut rates. Again, without looking at the data, things are going to go to the moon. It never does go to the moon. We always have had recessions the past 70 years, all right, folks? But again, people will want to say, no, this time it's different. We're going to go up, the herd, So it goes up, doesn't go up. We had this crash, right? And people are saying like, well, no, back then there was a banking crisis. There's no banking crisis this time around. This is different. That's what I'm hearing people say now. But let me remind you, we have a huge... Look, this is unrealized losses, right, that the banks are sitting on right now. And it's unrealized, so they're just trying to like squirm their way out of it. Look, in 07, 08, it was tiny. Back then, it was records, right, compared to before. We never, back then, it was only down this much. So 07, 08, this was, and then that tanked, right? We are at orders of magnitude greater losses that the banks are sitting on. They're not mortgage losses, they're other losses, right? Around interest rates and treasuries and all that, and debt, basically, the debt market losses. So there is a huge bank situation going on. They just don't talk about it because it's still unrealized, right? Which is why they want to lower rates. But I'm telling you, if you think that there's no bank situation going on, you're sorely mistaken. Does this mean it's going to pop up? Again, nobody has a crystal ball, but it's good to know what's going on under the surface, right? And you can't just, to say that there's no banking crisis and this doesn't apply this time, that's just being ignorant because of facts, right? Because of data, right? Doesn't mean it's going to happen, but you have to at least acknowledge the factual situation that we're in. So when you think about that, it's just not a good situation, no matter which way you look at it, right? The other thing that people think, and this is a huge misunderstanding, right, is that if the Fed cuts rates, then interest rates and mortgage rates will go down. And that's not necessarily true, right? The last time the Fed, last year, they cut 100 basis points, a full percent. They did a jumbo cut and then two 25-25s, right, for a total of 100 basis points cuts in the second half of last year. Now, people thought the mortgage rates is going to go down, but what happened was long-term interest rates went up. And that's what happens with the mortgage rate. The Fed does not control the long end of the yield, right? The market controls that. The Fed only controls the short end of the yield, but in the long end of the yield, the market controls because nobody knows what's going to happen in the future. And the mortgage rates are tied to, because the 30-year, 15-year mortgage rates are tied to the long end of the yield. So no matter what the Fed does, it doesn't control the yield in the long term. And the yield in the long term just keeps going up because the rest of the world, the buyers of U.S. debt, right, they think that the U.S. is never going to be able to repay its debt. Spending is, government spending has gone out of control, and Fed cutting more inflation is just going to snowball into something that will never be paid back. So the long term, people want higher interest rates for them to buy the debt. And so if you saw what happened last year, the Fed cut, and all that happened was interest rates in the long end went up, along which mortgage rates also never went down. And that's basically what's going to happen this time around because of the amount of debt that the U.S. has and the inflationary pressures with tariffs. Even though, even if you say that it's a one-time deal, which it may not be, but it could be, you're looking at a combination of inflation with debt resulting in higher interest rates demanded by buyers of long end treasuries, which means mortgage rates are not going to go down, which means the housing market is in a conundrum. And we'll talk about the housing market in another episode. It's actually, so, talk about real economy, employment, jobs are much worse than they thought, causing him to pivot. But the housing market is starting to crumble, and it's spreading like metastasizing cancer, right, across the country. What happened in Florida and Las Vegas, now spreading to other parts of the, like in Nashville and other parts of the country, and soon it'll be more and more. And that's going to impact the consumer sentiment. Now, I showed this in the last episode, but just so, so Powell set the stage, right? Saying data is not good, is worse, much worse than expected. Now, what's happening before September 17th, which happens to be my birthday, right? So I might get a nice little present on my birthday. But when the Fed comes out with their Fed decision, before that, there's a whole slew of data that's coming out, including the BLS, that may come out, right? And this is what Powell may know, and the Fed, and say like, oh, oops, for the last year, we may not have created the 1 million jobs that we said we thought we created. And this is part of the shocking surprise to the downside that caused him to pivot. They may come out and say like, look, in the past year, we thought we created 1 million jobs, but no, we didn't. That was fake. Just think about that. That's gonna, if that happens, that's gonna really be bad news. That's gonna almost solidify that we are coming into a recession, and inflation is going up, which means stagflation is all but guaranteed. And if you're thinking, we're just going to start cutting rates into stagflation, I mean, there's no way out, right? You cut rates, you get inflation, everybody becomes poor, you try to save the economy and job markets. You don't cut rates, right? Job markets get worse, we got an even steeper and more painful recession, and everybody suffers at the same time. So there's really no way out of this, right? If you think about it. I've showed the leading indicators before, so I'm not going to harp on this, but there is a ratio between the leading economic indicator index and the coincident economic indicator index. And I've explained to you before, leading indicator is like what it's telling you what's going to happen in the future, and the coincidence telling you what's happened now. When that ratio gets really low, right, bad things happen. We're very low here. We're almost at the record lows. And so every time, like now they converted to red bars, okay, instead of gray bars. But these are recessions, all right, these bars. Now every time we start going down, we have a recession, right? But every time we start going down really low, we have a bad recession, right? Last one being 07, 08. We're getting really low, right? We staved off a recession with all the drugs, injected into us with money printing. But we've staved off. But when it comes, it's like, not going to the restroom after eating a huge buffet and just keeping it into your stomach. We're going to have a massive explosion over the toilet bowl. It's going to be like, bum, bum. And that's coming, folks, right? Be prepared for that. Because look, this is crazy. The stock of one company, Nvidia, is poised to overtake the entire stock market of the second largest stock market in the world. This is crazy, right? This makes absolutely no sense to me. How can one company's stock, right, be larger than the entire stock market of the second largest stock market in the planet? This has never happened before, right? This is crazy talk. This is not going to end well. Guaranteed. It's just a question of when. Now, you might think I'm a bear and I'm saying like, oh, doomsday. But no, I'm very bullish on certain things. And one of them is the gold miners, which looks like it may be breaking. This is years, right? It may be breaking out here. So I've been very, very carefully monitoring not just gold, but silver as well, and also the miners, both gold and silver miners, because they're both on the verge of breaking out. And this is something that I am very bullish on, and I am looking to get in possibly soon at a good entry point, because I do think these things are going to skyrocket higher in the face of high inflation and lower economic activity in a recession, naming basically, which is stagflation, right? So that's it for today's episode. People think things are good, but in fact, things are a lot worse than we thought, right? And keep your eye on the fundamentals of the real economic activity here, right? Because that's what's going to matter in your daily life, in your job, right? In your mortgage, in your housing market. These types of things matter more than the stock market. The stock market will eventually follow reality, right? Don't get too concerned about that. If you do that, you'll stay prepared, you'll be ahead of what's coming down, and you'll not only weather it, but like me, you'll benefit from it, just like I did in 07, 08. See you in the next episode. Peace.